Hi guys. So today I wanted to go over something. I wanted to go over my portfolio management, or how I am managing my portfolio. Now, the reason I'm doing this video is because essentially I want to, in the future, start a fund, an investment fund. And this gives me experience, not the video, but what I'm talking about and what I will end up doing to manage my own portfolio. This will give me experience to take with me to when I eventually can start the fund. So yeah, don't take any of this advice as investment advice. I'm just telling you about what I'm doing. Please seek professional advice from a professional financial advisor, ideally a fiduciary, because they will act in your best interest. But yeah, let's go ahead. So when we're talking about a portfolio, an investment portfolio, Bespoke is always best because everybody has different goals. So you shouldn't do the same thing. My goals are very likely different to your goals. Okay. I have a different risk appetite. I have a different amount of money that I'm putting in the markets. There's so many different variables about us both. So you following what I'm doing will most likely not be good in the long run for you. It may not align with what you were expecting, basically. It kind of, this is a little analogy. A one size fits all doesn't really work in this context. It looks a bit baggy. It doesn't look fitted. But the same guy in a bespoke suit that's made for him looks much better, feels much better as well. It also goes back to what CAGR you're looking for. CAGR is the compound annual growth rate, and someone looking to gain 5% a year and 30% a year are very, very different people. 30% a year sustained is extremely difficult, and I'm not sure how many people actually do that. Most likely what happens is the higher the return your fund creates, the shorter the half-life of the company, of the fund is. That's why so many hedge funds and investment funds end up failing and just renaming and rebranding and trying to restructure because active investments on average doesn't make as much as passive investing. But we'll move on. So yeah, as I was saying, on average, the active funds lose, compared to the passive funds. Now, the blue is funds that outperformed the market, and the market here, the benchmark is the S&P 500, or their benchmark, sorry, apologies. So it will be the benchmarks of the different markets, basically. And the orange is underperformed markets, or they underperformed the market. So as you can see on a global scale, 86% of funds underperformed their benchmark. So you would have been better off just putting your money into a passive investment like the S&P 500, the FTSE 100, not touching it, leaving it, and it would have done better than you going out to find someone to manage your money in a mutual fund or something like that. Because you got to remember, mutual funds, they provide value, of course. However, they also need to get paid, right? So if you put, $100,000 into someone's mutual fund, and they expect to return you, 10% or whatever, they've also got to take a chunk of that. They've also got to, take their fee, because they've got to eat as well. And most likely, or more often than not, their fees are quite high. 1% doesn't seem like a lot, but over the long run, 1% of your portfolio value is a lot. It's every year they're taking 1%. $100,000, $1,000 is 1%. It sounds worse as your portfolio grows as well. So when you get to $1 million, they're taking $10,000 a year, essentially for doing the same job they were doing when they were taking $1,000 a year. And their risk is not really changed much, is it? It's the same. So in a portfolio, diversification is extremely important. And the reason it's important is so that you can reduce volatility, basically. As it says here, diversification is having less than perfectly correlated assets in a portfolio, which will reduce volatility. So let's give a little example. You've got one portfolio you've just got Apple in it, Apple stock. Yeah, so 100% Apple. Now portfolio 2, you've got Apple and Citibank in it. 50% of Apple, 50% of Citibank. Now, if Apple's share price falls 50%, in portfolio 1, your entire portfolio falls 50%, right? Now, in portfolio 2, only your Apple weighting will fall 50%. So your 50% of Apple falls 50%. That means it's gone down to 25% of your portfolio value. So you're still at 75% in your portfolio 2, assuming Citibank stays the same. Now that's, you're at 75% in portfolio 2 compared to 50% in portfolio 1. So it basically smoothens out the bumps in the market if you play your cards right. As it goes back to this old saying, don't have all your eggs in one basket. Have them in many baskets that have similar potential returns, but are, have different fundamentals basically. If basket A stops returning you returns, you've still got basket 2, basket 3 to continue to return to you. So yeah, it's very simple, but that's all it needs to be. It's a simple thing to understand. It doesn't need to be difficult. Rebalancing is also very important, and essentially rebalancing is done once a year. Can be done more, can be done once every quarter, so 4 times a year, but I will be doing it probably once a year, maybe twice. We'll see how it goes. Depends on what's happening in the market. But what rebalancing does is allows you to potentially increase your returns because you can sell your overweighted assets. Like basically, the high performers in your portfolio are likely to be overvalued in the short run, okay? And the low performers in your portfolio are likely to be undervalued in the short run. So if you sell some of your overvalued asset, yes, then you can use that to go and buy the underperforming asset. And then this, when it ends up catching on, you've got more units basically. So your returns will be higher, right? And, and vice versa. When the high performer becomes a low performer, you do the same, It is a very important thing. As it says here, also the discipline of rebalancing can prevent panicked moves and increase your long-term results, which is what I just explained. This is a portfolio that's rebalanced over 30 years, probably once a year. And this is a portfolio that's never rebalanced. It also does decrease your risk rebalancing because look, if you're doing a 50-50 stocks and bonds portfolio, then you rebalance every year, you get that back to the 50%. Yeah, 50% of stocks, 50% of bonds. Because more likely than not, stocks or the bonds will have increased more than the other. Versus if you never do that, then equities will grow faster than your bonds. So, you're just going to keep decreasing the weighting of your bonds and increasing the weighting of your stocks. And then, if the market falls 50%, the equities market, then look how much of your portfolio is made up of equities. Then you'll feel it a lot more than, this, where you've just got 50%. So the way I am about to invest, or have been investing actually, is in innovation companies. I don't think that the old model of just buying index funds alone is the best. Basically, it's not the best for me because where I am in life, how my time horizon and my risk tolerance right now doesn't make me feel like I should just put my money into index funds because I'm probably not going to get a hold of the most innovative companies that have the highest returns because the most innovative companies are not in the indexes because they are small cap companies, essentially, most of them. They only come into the indexes once they've grown in value, and in that case, the big returns have already been made. So basically, these are the areas I'm looking into now and where I have put money into. So energy, it's not rocket science. I'm not talking about old school energy, not talking about oil. I'm talking about battery, solar, wind, etc. Batteries for electric vehicles, batteries for our devices. Innovations in batteries is very important. Solar is also important because a lot of the world does actually have great sunlight all year round. Middle East, for example, and although they do use a lot of oil now, and they are known for oil, they have also been investing heavily into solar fields, and a lot of the countries in the Middle East, especially the GCC, have vast amounts of solar fields and solar power. Some of them even have full cities that are just using solar. So it's an interesting time. Life sciences is something else which I think is very important. Life sciences includes biotechnology, pharmaceuticals, medical devices, genetics. There's many different areas within, but it is an interesting area, and an area that can potentially return huge returns because of not how new it is, but where technology currently is and what that can be used for to aid these startups and companies and all that to innovate. Also, equality is important. Not only is it important to me morally, but it's important because so many people in the world, probably more than half of the world, don't even have access to a bank account, or don't even have access to clean water or something like that. So equality is very important because not only is it morally good and bringing more people onto acceptable living standard, but it also shows that there is a huge market out there that needs to be served in these countries that are underserved right now. Financial sector. So yeah, fintech is quite hot, but I'm not just talking about fintech. Fintech is kind of the norm now. You have to be a fintech company if you're in the financial sector. But yeah, digital wallets is very important. Now you don't really need to have a card. You can just use your phone. I remember at university, I would walk around without my wallet, without anything, literally just my phone, because everywhere accepted contactless. I had access to all my cards on there. I never needed cash. Maybe I'd carry, a little bit of cash just for an emergency, but didn't even have to think about, do I need my wallet? I was that confident that I could get around the day without needing it. And that included going on trains, that included on getting in Ubers and eating food and, going hours away from where I lived. So it wasn't just like, up the road. I'd gone on fairly long trips and didn't need to bring my wallet either, which was quite a nice feeling. I don't like the big feeling of a wallet in your pocket. And also lending to all people. This is an interesting thing because there are companies now that are making it extremely easy for, say, businesses to get funding. But essentially, these are all the areas I'm looking into now. It will change. There will be more areas added and maybe some taken away, but I don't think many will take away from this because this is basically my core beliefs right now and what will be huge in the future. Now, this is just a little example I wanted to give. The S&P 500 from February data was 32 trillion of all the companies. Basically, their market caps added up equals to that. Now, if you take the average of that, it's 64 billion. Of basically divided by 500, you get 64 billion. Now, that's the average size of a company in the S&P. Obviously, some will be a trillion and some will be a few billion probably, but the fact that that's the average size of a company, it shows that most of these companies are really well established and have been around for a long time. So they're not as young and they're not as hungry and willing to take risk as, say, the early IPO companies, companies that have just IPO'd in the last year or whatever, or few years, or companies that are startups and being SPAC'd by SPAC mergers, basically. These companies are the ones that are going to provide the innovation and therefore the returns. It also makes sense. These big companies in the S&P 500, they have to provide their returns to investors in dividend payments. So that money could be spent somewhere else to innovate, but it's not. It's going to the investors' pockets. It's just one example, but this is why you won't find your innovation. You won't find the innovation with the highest returns in the S&P 500 or any other index. It's not to say I won't put money in. Let's go to the next slide. So yeah, basically in the S&P 500 or indexes, basically index funds, there are things called value traps. Although the S&P 500 and other index funds does hold great companies, they also hold companies that are only being propped up in those indexes because the investors are passively investing. So when you buy an S&P 500 unit, you're buying basically, let's just simplify, one of each share in the S&P 500, one of each of the companies. Let's say an unweighted S&P 500. You buy an Apple, you buy a Tesla, you buy this, that, whatever, all 500. Not all these companies have the same growth prospects, okay? Apple will have very different prospects, or Tesla will have very different prospects to one of the bottom companies that are literally just there because they're being kept in from people like you and me buying the S&P 500. So it goes on to the point of not all the companies in the S&P 500 are innovative. There are many companies at risk of creative destruction. What is creative destruction? Well, it's basically an innovation mechanism whereby new production units replace outdated ones, okay? Now you can think of that from many different industries, like the banking sector with fintech, you know. These internet banks have taken quite a large market share of these traditional banks. That's one example of creative destruction with innovation. So this is an example. Will Ford be as valuable in the future with EVs, or will Tesla be the one? You know, that's just one example. And then, as I mentioned earlier, dividend stocks probably have not been investing heavily into becoming a part of the new world, the innovation world, basically, because they are paying out their profits and dividends. There's an opportunity cost, isn't there? Instead of paying out that dividend, they could go and put it into investing in new technologies to be ahead of the game in the future. But, I mean, to each is their own. Every company is different. Investors want different things. So, yeah. So my strategy, I'm going to think, okay, what is the future? And as I mentioned, the sectors that I was looking into, that's what I think the future is. What I do is I find a good company by doing my due diligence. Due diligence is just your research. Do your research, you know, look on Yahoo Finance, look on the investor relations of the company, you know, even forums, you can get some decent insights. Don't take everything at face value because you really don't know who's talking on these forums. But I kind of use it just to get an idea of what people are talking about out there. But yeah, find a good company. If it's got good fundamentals, buy it and hold it. Ride your winners is something that the guys from the All In podcast say. And I couldn't agree with it more. And I don't know how many times I've gotten out of a position because I thought, oh, let me take some profit. And then the company goes and does another 100, 200%. So yeah, buy and hold. Only sell if the fundamentals change negatively. So only if there's a big bad change in the company, then you can sell. Or if you need the cash. Otherwise, just keep it and ride your winners. Rebalance yearly or monthly, depending on the market. I'll see, but for now I'll be rebalancing yearly. And I will hold ETFs, so that will include the index funds. The reason the index funds are here, it will probably be passive funds. It won't be so many active mutual funds. But the reason I've put this here in my portfolio, in my strategy, is because I'm admitting that I don't know everything, and there is a large risk that the companies that I choose don't end up performing as well as the passive markets or the overall markets. So that's kind of my hedge, you could say. So yeah. If you've got any comments or anything you'd like to add to what I've just said, just leave your comments down below. If this did provide any value to you, this video, I'd appreciate if you like the video. And yeah, take care, guys.